The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. Here are your headlines today. Peak rates pushed German lender Commerzbank to a near 30% surge in quarterly net profit and its best result in a decade. US producer prices come in hotter than expected, setting the scene for today's closely watched CPI report, as Fed Chair Jerome Powell signals rates will stay higher for longer.
By many measures, the policy rate is restrictive. The question is it sufficiently restrictive? And I think that's going to be a question that time will have to tell.
The Nasdaq closes at a new record with the Magnificent Seven riding high. As Alphabet CEO Sundar Pichai tells CNBC, the boost from AI still has a long way to run.
Very early days. We're going to be able to do a lot more. I think that's what makes this moment one of the most exciting I've seen in my life.
And President Biden hits China with $18 billion in new tariffs. The US ambassador to the EU tells CNBC exclusively the White House is sending a clear message to Beijing.
The message to them from us would be the same message they would give us, which is we're going to protect our workers and we're going to protect our sectors of the economy that are being attacked, basically, by the PRC.
Fascinating data last night, but more fascinating, the market reaction. I think it's quite extraordinary. Let me just go through the numbers as well. US producer prices topped forecasts in April. They rose by 2.2%. That is the biggest increase in a year. Now, as Karen and I have been describing with insurance costs and others as well, the gain was driven largely by services, while some categories that are used to calculate the central bank's preferred inflation measure, well, they actually ease. But later today, we're going to get the key inflation report, and that's the CPI figures for April. Meanwhile, it was more of the same from the Federal Reserve. In fact, if anything, there was a tad of mea culpa about it, wasn't there? The Federal Reserve Chair Jerome Powell described the producer price index report as more mixed than hot. Okay. Speaking at the Foreign Bankers Association in Amsterdam, Mr. Powell also described current policy as restricted and reiterated the Fed will likely keep rates higher for longer.
Having restrictive policy, we have the highest interest rates in some time. I think that it may be that takes longer than expected to do its work and bring inflation down. I am confident that we will do that, but that we will get inflation down to 2%, and ultimately we will do what we need to do with our policy rate. By many measures, the policy rate is restrictive. The question is it sufficiently restrictive? And I think that's going to be a question that time will have to tell. Entertain the possibility is, that could be a very small probability, but I have said that I don't think that it's likely, based on the data that we have, that the next move that we make would be a rate hike. I think it's more likely that we'll be at a place where we hold the policy rate where it is.
All right. At a minimum, then, we can agree that there was nothing dovish yesterday in terms of either the PPI or Powell. But the markets, again, on another day, the markets moved down initially on the PPI and then they rallied again. But on another day, you could have potentially seen quite a violent reaction on both the comments and the PPI, Karen, as well. Yep. So the fact that the market was so calm is beginning to worry me that there's a degree of complacency coming in, or perhaps euphoria that we're not necessarily talking enough about. I don't know.
I wonder without Powell whether we would have seen more of a market reaction, because Powell's message still dangling the promise of rate cuts, effectively suggesting that rate hikes are a very low probability at this point. So investors proving patient, that they're prepared to wait it out for longer as long as those cuts come through at some point. And you can see it in the market reaction. A record high on the Nasdaq, Magnificent Seven playing their role, 0.75% higher for the Nasdaq. Actually, Broadcom, the big moving leading stock for the Nasdaq. For the S&P, it was one of the usual suspects. It was Nvidia. So as we creep higher in these markets, about 1/3% off a record high in the S&P 500. And after what was a very strong run for the Dow last week, ninth positive session in 10, it is also a whisker off a record high, about 0.8%. So a green across the boards is what we've witnessed as a result. But CPI today, that'll be key as well. The market's still looking at some hot levels in the core components, and that is going to be interesting for the market to digest. Asian markets, we're ex-Korea. We're also not seeing trade in Hong Kong today. The markets are trading. We've got a little bit of green splashing up again on the Japanese market, but it is light. The Nifty 50 at India putting on about 0.1%, but a slight decline on the Shanghai and Shenzhen composite. The opening calls, this is what it looks like across the region. You can see we are chasing upside, so we're looking to set even a higher bar this morning. A fresh record on the Stoxx Europe 600 yesterday. What we had across the board, FTSE was up another 0.1%, 0.2 on Stoxx out of France, and you can see we are perched higher, 100 odd points to the upside on the Italian market, 49 on the DAX, and about 33 up on the FTSE 100. A lot of company earnings out today too, so we'll get a little bit of earnings reaction as well as that reaction to the Wall Street trade.
So very kindly, the ladies and gentlemen over at Bank of America have sent me a whole raft of different pieces of copy on their latest fund manager survey, and I'll just go through a couple of points. I know we've got to move on, but just because I thought it was very interesting. Positioning from fund managers is the most bullish since November 21, driven by optimism, and I thought this was interesting, on rate cuts rather than EPS. Rate cuts that don't appear to be happening.
Back to the monetary policy re-rating
story.
story.
Which I think is fascinating. I would have thought, well, they're relying on the earnings because rate cuts aren't happening. But no, it's basically driven by optimism on rate cuts. 8 out of 10 say cuts in the second half and no recession. Okay. Fund manager survey cash levels are down to 4%, which is a 3-year low. So that's really interesting. That's real money.
Invested.
Not real money being put to work. Stock allocation, rather than the barbell with the bonds, stock allocation is at the highest level since January 2022. And I thought this next line was very nice. There's so much more there, but I'll just do the next line. Sentiment not at, and this is their words, not mine, close eyes and sell levels, but risk assets vulnerable to more evidence of stagflation.
Well, we've heard it a lot from every other fund manager that we've interviewed, that they still like the Magnificent Seven. They're not willing to sell or lighten up in that area, but it's some of the managers looking beyond further value. So stock picking going on. I think we've seen it in the Dow the last number of sessions where you've seen that breadth in the market as well. Yeah,
I think you're absolutely right. And then when I look at the dogs of the FTSE, so to speak, I see a lot of that breadth that you're talking about coming to the fore. The US has hiked tariffs. This is a very big story, isn't it? The US has hiked tariffs on Chinese imports, including electric vehicles, semiconductors, batteries, steel, and aluminum. I wonder if that's similar to aluminium. The Biden administration announced tariffs on Chinese EVs will quadruple to over 100%, while semiconductor duties are set to increase by half. Well, the US Trade Representative, Catherine Tai, told CNBC that the US must protect itself against Chinese overcapacity.
The overproduction that we are seeing China double down on in order to export their way out of their economic downturn, that over time has shown us that China is exporting its own economic challenges to the rest of the world, exporting its own unemployment, for instance, to us. That is something that the rest of the world, the United States at the leader, can no longer accept. We cannot absorb the negative consequences of China's own economic policies and decisions.
The US ambassador to the EU struck a similarly hawkish tone on China. Speaking exclusively to this channel, Mark Gitenstein said the talks are ongoing about potential further action from the bloc. Sylvia conducted that interview, as you can see on your screen there as well, and joins us with more. Sylvia, I'm sure a fascinating interview with fascinating timing.
Exactly. The timing couldn't have been perfect, really, because it gave us a better understanding about why the United States decided to go ahead with this huge package of tariffs on Chinese goods. But on top of that, it also shed light on what the EU might do next in this context. And let me just remind our viewers that the EU started an investigation in October looking at whether Chinese authorities were granting subsidies and fair subsidies to Chinese EV makers. Now, that investigation investigation is ongoing. The European Commission, the institution you see behind me, is conducting that work. And the legal timeline suggests we might see a conclusion this summer. So there is some speculation that perhaps we're going to see the EU also going ahead with tariffs on Chinese EVs. Let's see what will happen there. However, when I spoke to the US ambassador to the EU, he did say that there's a shared and a common vision between the EU and the US on this matter. Let's take a look.
I've sat through 2 summits now between the EU and the United States, and none of this will come as a surprise to either side, especially to President von der Leyen or President Michel, because they've talked extensively about the problem of overcapacity in the People's Republic of China and how it's distorting our markets in the United States and their markets in Europe. And I think the message to them from us would be the same message they would give us, which is we're going to protect our workers and we're going to protect our sectors of the economy that are being attacked basically by the PRC, especially in the green tech area. I mean, they had their experience with solar panels. They're now facing the prospect on electric vehicles and batteries and critical minerals, as are we. So it's not a surprise to either side. It's, I think, the message of us to them and them to us is we're going to protect our workers and our businesses.
You've mentioned that you were in the last 2 European Council meetings.
No, European summits.
Summits.
Yeah.
I was just wondering, to what extent are you coordinating with the EU these tariffs on Chinese EVs?
Well, I actually don't know what they're going to do on their own their investigations on overcapacity in the electric vehicle markets. But I've been in the meetings where they've talked about it, and they clearly have a common vision of what the problem is. And it's not simply with green tech in the EV, the electric vehicle area. It's also on aluminum and steel. The global arrangement on aluminum and steel is now beginning to focus on overcapacity and abuse of our markets, as it is with critical minerals. So they've talked a lot about it, and to the extent they share values, the only problem is working out the details. And in that sense, we're negotiating agreements between the two systems, between the EU and the United States.
Now, also this week, we heard from the French President, Emmanuel Macron, sounding actually quite supportive of the idea of introducing EU tariffs on Chinese EVs as well. He's very much of the opinion that that is also a matter of economic security for the European bloc. However, yesterday, the German Chancellor was in Sweden, and he actually sounded a little bit more careful when it comes to that. He actually said that there's a difference between the US and the EU here, and we know that German car makers are a lot more exposed to potential tariffs in this context than are, for instance, any American car makers too. So let's see what will end up happening here. However, I have to say that these topics of potential tariffs on China actually feed into the broader themes of some of the discussions happening here in Brussels, and that includes EU competitiveness. I have to say that later this morning we'll have an interview with Enrico Letta. He produced a report recently looking at how the EU can make the single market deeper, of course, and also later on this morning we'll be speaking with Paolo Gentiloni as the European Commission is preparing to put forward new economic forecasts as well. So a very busy morning here in Brussels, guys.
Absolutely. Can't wait to see Mr. Letta and Mr. Gentiloni's interview as well. And by the way, I've just been in fact, I'm still on the website. Very kindly, shout out to Vicky McKeever, who's written up your full interview there. So thank you, Vicky, for writing that up. That is on CNBC.com.
A lot of earnings around at the moment. Alcon shares surge after first quarter earnings. We'll bring you Arabile's exclusive interview with the CEO right after the break.
Ambition to me is about doing better.
I think ambition creates a pathway.
Best advice I can give someone starting off a career is don't have a career, have lots of careers, try loads of different things.
Talk to people and put your ambition out there.
I don't feel that I've hit peak ambition because it's a learning journey.
CNBC is where ambition meets opportunity. What does living ambitiously mean to you? Hear it from our CNBC anchors, reporters and global business leaders on CNBC.com.
Welcome back. Shares in Alcon jumped to a record high after the Swiss eyecare group reported strong earnings for the first quarter. Arabile spoke exclusively to the CEO David Endicott and asked if the backlog around stock levels has been dealt with.
We're in a very good shape from a supply chain perspective. So, we have invested a lot in inventory last year. There were shortages in chips and a number of, electronic elements that make up our heavy equipment. Also, some raw material has been difficult to find for us, but we're in a very robust position, both on raw material and in finished goods inventory right now. So we don't see or foresee any real significant problems with inventory going forward.
Yeah, I mean, just talking about some of the things you may face in the geographies you are then, playing in as well, whether it be out of the United States or the rest of the globe as well. I mean, what are the key concerns here as trade barriers and trade issues, of course, make up a key bulk of conversations that are happening right now?
Yeah, look, I mean, we're always interested in the Asian markets in particular because they're high growth for us, and China in particular. So the dynamic that is the China-Western dynamic is an important one to pay attention to. We're obviously interested in what's going on in all the conflict areas because, of course, we do business in nearly every country in the world. So, it's important to make sure that we continue to provide access to products, regardless of the market, regardless of the circumstances, because people need to see, and obviously we want to make sure that we can support the surgical needs, of their physicians.
Yeah, and with that, is that ultimately your biggest risk at play right now? Just those conflict zones and perhaps the slow growth coming out of China?
Well, I think if you were asking about risks, I mean, I would probably think about China as an important one, but I also think about the foreign exchange and the dollar strength right now. So for us as a business, if you will, probably the thing that we're sensitive to is the yen and certainly the euro and the Swiss franc. But directionally, the yen has taken a significant kind of downward turn for the last several years. That's changed a lot. Everybody I think who's following and has a significant business in Japan, I think has had an impact on that. The other two issues, I think we manage pretty carefully, and I think directionally we feel comfortable with them.
Reddit saw its second highest close since going public as meme stocks continue their rally. Shares of GameStop, AMC and BlackBerry also climbed for a second straight day, following the re-emergence of Keith Gill, also known as Roaring Kitty. Kate Rooney filed this report.
This has been meme stock deja vu. The GameStop frenzy is back. It's been sparked by a series of social media posts by Keith Gill. If you followed the GameStop saga back in 2021, you might know that name. He also goes by Roaring Kitty. He testified in front of Congress alongside Ken Griffin. We hadn't heard from him in about 3 years, and yesterday he was back online, has been tweeting movie clips, things that really had nothing to do with GameStop, but online traders got the joke. They interpreted the message as time to buy. I have been talking to folks trying to figure out what all this means. One key takeaway is a lot of people do just see this as a joke. They are having fun on the internet. There are no fundamentals in terms of what they're pointing to or why they're buying, and they're just trying to get in on some of that momentum. But it does signal more risk-taking. GameStop has been the biggest mover so far, but there's also AMC, which announced an equity offering. They did complete that offering before yesterday's surge, so didn't necessarily capture that upside. There's also BlackBerry, names like Tupperware. All of these are household nostalgic companies with struggling financials. They are also highly shorted, attracting some traders who want to just inflict pain on hedge funds or any sort of professional trader that's betting against these stocks. GameStop bears had pretty much gone into hibernation after 2021, but short interest has climbed in recent months. Last month, it was up about 5% to roughly 24% of the float, or essentially outstanding shares. And these outsized moves are likely the result of some short covering over the past couple of days. And GameStop shorts, at least yesterday, lost about $1 billion. That's according to S3. Vander Research, meanwhile, is addressing today who is actually doing some of this trading. It's not just retail traders. They say quant and hedge funds are much better equipped to handle retail surges today versus 3 years ago. They also estimate retail investors were responsible for about 7% of GameStop turnover and 10% of AMC trades over the past 5 days. They also do expect more retail traders to jump in on these names in the next couple of days. Coming up here, Kate Rooney for CNBC Business News in San Francisco.
Just briefly, I thought that was a brilliant report from Kate Rooney. She covered so much ground, but of all the amazing nuggets of information, it really was a very good report. one thing struck me, and it's very important to remind that this isn't just, oh, I've got my COVID check money, I'm going to take on the hedge funds. I mean, hedge funds, you know, presumably they should be doubling down rather than suffering margin. If they're suffering margin calls on their short positions, but surely if they thought it was a great stock to short, 76% lower, they should still be shorting it now more aggressively, unless they've got themselves over leveraged. But the point I thought that Kate made that I thought was really brilliant is, let's not pretend this is just the little moms and pops retail investors or some guy sitting in front of his computer screen over there and his Robinhood account over here doing it. This is algorithmic traders and the machines spotting the trends and exacerbating those trends as well. This is not just individuals creating this problem for those shorts.
Yeah, there are some individuals though. I mean, if you look at Robinhood, $5 billion in equities trading took place on Tuesday, according to the CEO, who tweeted out the level of demand that had returned. I think the other feature here is that there's a lot of cover from a record territory they see on the stock market. So, I mean, hard to have this sort of position when there is a lack of confidence out there. So, again, to the sort of feature of this market that we're seeing, these types of traders are being given some extra strength, I think, thanks to the market dynamics here. And it's fascinating to your point. Can they continue to trade like they've been trading because they're not sitting at home? That was one of the arguments, that you won't see meme stocks be as successful this time round because people are not sitting at home with those COVID checks to spend. But, you know, the activity's there. Let's just see whether it can be sustained.
I think it's because of the way that trading is done these days by the algorithms, by the high frequency traders, by the machines. I think it makes it stunningly dangerous to have these short positions, or even a long position on something if someone takes the position the other way. And it just underlines something that a lot of key market participants have said to you and I over the last year or so, that the nature of who is trading, who is behind moves, it has changed completely in the last couple of years. I think it's just brilliant, fascinating, scary, all at the same time. OpenAI's co-founder and chief scientist, Ilya Sutskever, is leaving the company. In a statement, he lauded the company's growth trajectory as, quote, nothing short of miraculous, and that it will create the next breakthrough in artificial intelligence, which will ultimately aim to compete with humans on a range of cognitive tasks. Sutskever was one of the board members behind CEO Sam Altman's temporary ouster last year, a move he has since admitted he regrets. Google has showcased its latest artificial intelligence model hot on the heels of OpenAI's ChatGPT update. Google says the new lightweight AI, known as Gemini 1.5 Flash, will be able to summarize conversations and extract data from documents in a faster and more cost-effective way. CEO Sundar Pichai told CNBC he feels the public is growing increasingly at ease in working with AI.
In some ways, we've been evolving it continuously. The good thing about search is people comfortably use it. They take it for granted. We've been answering questions for a while. But with generative AI, we can do it a lot better. We've been testing it for a while, and we now feel it's the right moment to roll it out broadly.
And feedback has been good, right, from the users?
Yeah, user engagement has been positive. The feedback has been great. I think it makes the product much better, and so it's a great direction.
What about advertisers? Because this will change the business model. In some cases, you're going to get links from a traditional search. In some cases, you're going to get a generative AI answer, which would move those links lower down on the page. Are they ready for this moment? What are you telling them about their ability to reach your users?
You know, the great thing is users still value commercial information. Our ads work based on intent and quality and relevant at the right time. We've been able to test that in the context of AI overviews, and it's working well as we expected it to. So I think it'll be a smooth transition, and that's what we are seeing.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.